Hello, everyone, and welcome to Fairfield County SCORE's live webinar on financial funding resources for small and medium businesses. I'm Bud Freund, the webinar coordinator and a business mentor here at SCORE Fairfield County, and I will be your host. Our speaker today is Louis Silva. More on our speaker in just a minute. This webinar is being done in collaboration with the Monroe Chamber of Commerce, the Monroe Library, and the Monroe Economic Development Commission. And speaking on their behalf is Ray Giovanni. Ray?
Good evening. Again, I'm Ray Giovanni. I'm the president of the Monroe Chamber of Commerce. I'm so appreciative to work collaboratively with this team. We're going to hear some great things tonight. So thank you for attending tonight's webinar. For this Build Your Biz workshop series that we created, we're very pleased to welcome the Monroe Economic Development Commission as a co-sponsor. This series was created in response to a survey that was sent out by the Chamber as well as the Economic Development Commission, and where we received over 100 replies. And today we are at week number 4 of our 6. We've been alternating between noon and 6 p.m. start times to make sure that we accommodate everyone's different schedules. So if you've missed the last episodes, you can go to SCORE's on-demand website to find the links to them. They're worth your time. Or subscribe to our Chamber's newsletters, where we are showing the website links to the webinars that have taken place so far. Each week, we send that info out about all of our upcoming events, specifically this 6-week Build Your Biz workshop series. The next webinar and the links to the prior ones all will be included. Our next 2 topics are going to be e-commerce, marketing strategies with Cliff and Eco, and also our trusted advisors, which is why it's so important to surround yourself with good people to help you make biz decisions, presented by Marianne Croce, who's one of our chamber members. Which brings us back to the important topic for this evening. I'm looking forward to hearing from Louis Silva, who will be sharing such valuable information, which with all of us, related to financial and funding resources for small and medium businesses. So let's not hold this up any longer, and I turn this over to Bud so that we can enjoy this wonderful presentation. Thank you.
Thank you, Ray. Just a few more words before we get started. First of all, about SCORE, we've got about 240 offices nationwide and 11,000 volunteers. We're part of the Small Business Administration, and here in Fairfield County, we have over 100 volunteers with a wide range of industry, process, and subject matter expertise. We offer 3 primary value-added services to small business owners. First, free one-on-one counseling. We used to do face-to-face. We should be back to it very soon. We're on the telephone, we're in email, we're doing video, and you can get to that from our website, fairfieldcounty.score.org, by clicking on the button that says Request a Mentor. Second, we offer educational workshops and webinars like this and do over 150 a year. And finally, on our website, there are extensive resources on all kinds of subject matter and from all sorts of experts. And we've converted some of our in-person workshops to live webinars due to what's going on nationally, but you can look for specifics, obviously, at fairfieldcounty.score.org. Some useful information specifically about tonight. If you have a question, please use the Q&A window at any time during the presentation. It's located in the lower part of your screen. Our webinar will end at 7 p.m. to respect your time. The session is being recorded, and a link to the recording will be available at fairfieldcounty.score.org within the next few days. Now, as for Louis, he is the president and CEO of the Community Investment Corporation. He joined CIC in 2018 and previously served as CIC's vice president and was responsible for economic development financing via the administration of SBA 504 loan program and other loan programs. Lewis also serves as a legislative committee member for the National Association of Development Companies. He spent 5 years in banking in several capacities within the retail operations and commercial sectors of banking. Lewis, it's all yours.
Thank you, Bud, and thank you, Ray. Certainly a pleasure to be here with you all. Ray and I we were chatting before. It's amazing how much information's out there, and it's certainly nice to be able to be here this evening to provide you with a very simple format that has insightful information. And I'm happy to share resources and I'm happy to follow up if there are any questions that go unanswered and what have you. I wanted to share a little bit about CIC here. So CIC has been around since 1973, and we're a nonprofit certified development company with a mission to promote economic development and to provide financing and practical guidance to small business entrepreneurs who really have powerful ideas and need more power to grow them. We're licensed by the Small Business Administration to administer various SBA programs, such as the 504 program, Community Advantage, and the Microloan program. Currently, we serve 3 states, Connecticut, Rhode Island, and Massachusetts. We have 4 loan officers who are dedicated to administering these CIC programs. I will say we've got a very savvy business advisor on staff as well. He happens to be a SCORE mentor with the Fairfield County SCORE chapter. So we're delighted that we can have 2 powerful organizations out in the community really just providing great information and education at all times. On the economic development front, every loan we administer must demonstrate that we are stimulating economic development. As an example, if we grant a loan to a minority-owned business or a loan to a business located in an underserved community, or if we even demonstrate that we are providing financing that will allow a company to create jobs, these are all economic development initiatives that we must strive to accomplish. So why does a business need financing? Whether you're looking to start a business or looking to expand an existing business, businesses need financing for a variety of reasons. There's a plethora of reasons out there, but really we can boil them down to 3 most common needs. The first is working capital, second is asset purchases, and the third is growth. Capital, whether in the form of debt, equity, or a combination of both, is certainly required to finance these needs. To start, one of the most common financing needs, as I mentioned previously, is a need for working capital. And that holds true for both startups and existing businesses. So why is there a need for working capital? It's needed really to cover short-term expenses such as startup costs, inventory, short-term debt, and operating expenses. Every single business has a working capital need. It's really the lifeline of running a smooth operation. Some businesses do require more working capital than others. It really depends on the industry. And some businesses have seasonal needs for capital. If you have a business that has a peak operation during the summer, you'll find that throughout the year, your capital needs are going to be relatively low. And then when you're ramping up for that busy season, that capital need is going to be ramping up as well. Manufacturers, that's another capital intensive industry. Manufacturers are often considered to be capital intensive due to their inventory and capital needs and so on. Working capital is typically financed on a short-term basis. And the reasoning here is that a working capital investment generally creates income almost immediately. I'd argue that discussing your working capital needs is one of the most important discussions you should be having with your advisory team, with your lenders, with your bankers, because frankly, we find that businesses often fail when they're undercapitalized. So again, cash is absolutely key, and the more capital you have, the better off you'll be. Financing fixed assets. Every business arguably does have a need for a fixed asset, and that asset could really vary on a wide range. Generally speaking, fixed assets include equipment, machinery, vehicles, and real estate. Financing the acquisition of an asset requires capital. It's very rare for a lender to provide 100% financing for fixed asset acquisitions. In most cases, it requires an equity injection from the borrower. That said, unlike working capital, fixed assets can be financed over a longer period of time. Typically, the term will match the asset's useful life. Generally, terms for equipment, machinery, and vehicles range between 1 to 10 years, and real estate ranges anywhere from 10 to 25 years. Fixed assets equal collateral. Collateral is a critical component in financing as it provides the lender with a hard tangible asset that can be liquidated. Collateral, whether we want to or not, it's really at the center of every financing discussion, and we'll talk about that later on. Financing and growth, folks. If you haven't heard it before, you'll hear it first. It takes money to make money, plain and simple. Companies in growth mode may need to leverage debt to see their expansion plans through. Growth needs are typically centered around working capital and fixed assets. Common uses include increases in inventory and accounts receivable, investments in new or expanded facilities and equipment, replacement of old or worn out fixed assets, modernization and operational efficiencies. To meet these growth demands, it may require a combination of short and long-term facilities. And we'll certainly discuss that in a few moments as well. You'll find that in a scenario where there is growth, you'll find that you'll see a line of credit come into play, and you'll find that you'll see a term loan come into play to finance that particular fixed asset. So it's called creative financing. We try to match the demands. And we typically say a short-term need matches a short-term credit facility, and a long-term need matches a long-term credit facility. And Bud, if there are any questions in the chat, I'd be happy to pause and answer them at this point.
Currently, no, you're on a roll.
All right. So where do you get debt? Starting with private sector, really banks and credit unions are probably your most common debt sources. Outside of a bank or credit union, you might find mortgage companies out there providing a source of capital, and private lenders, which we commonly refer to as hard money lenders. Banks and credit unions charge interest in return for their investment, or what we would call a loan. And the interest is typically due within a specified period. These lending institutions rely on a business's ability to repay and the value of assets offered as collateral. If a business has good probability of a profitable future, it stands a very good chance of obtaining a loan from a bank or a credit union. Equity financing, which is also referred to as patient capital, requires an ownership interest in a venture. All equity investors expect appreciation in their investment. Think Shark Tank in these particular scenarios. Private equity sources include friends and family members, angel investors, private and corporate investors, and venture capital companies. Dequity, which is a term we like to say that we invented, is a combination of debt and equity commonly leveraged as a form of financing. Really, in layman's terms, it's equity investors, mostly friends and family members, who want an equity position but don't want to be patient. They want to be repaid in a short period of time. Equity investments are very popular, albeit it could very well be a risky proposition for the business owner. It certainly goes without saying that when you are entertaining equity or a venture capital firm, you should really consider all the requirements and stipulations that come into play with an equity investment before moving forward. Unfortunately, we've seen many instances where an entrepreneur had a very good idea, had a solid business plan, but needed capital to make it happen. And really, without reading into the fine print and into all the legal jargon, we've seen instances where a venture capital firm, and not to say that this happens all the time, but a venture capital firm ended up acquiring a significant portion of a company and ultimately would take over and take over the company and all the IP and the assets and what have you. Again, not to say that it happens all the time, but ownership interests that are outside of the person owning the business are very, very tricky scenario. It does require a lot of thought, and it requires a lot of good structuring and advisory as well. Public sector financing. The public sector is an interesting place. It really provides a bridge to capital gaps in the private sector. It requires a true partnership with the private sector. For many borrowers, access to capital is more critical than the cost of capital. Sources of public sector financing are generally public and quasi-public institutions. In Connecticut, think Connecticut Innovations, or even your local municipalities. Some economic development commissions or corporations have funds that they've created themselves, such as a revolving loan fund, that whenever they're confronted with an opportunity to either remediate a brownfield site or to take a blighted property and rehab it and or increase the tax base or provide some sort of neighborhood development, they might be a really good source of capital to get the project up and running. Other sources include nonprofit economic development entities. So think of CIC, There are many other organizations like CEDF, HEDCO, Capital for Change. All of these organizations are considered nonprofit economic development entities, and we're all here to help and provide another alternative source of capital. Public sector investments target ventures or projects where the economic and social benefits outweigh the risk of financing. Factors that are typically considered include job creation and retention, neighborhood development, and tax base increases. As I mentioned earlier when I started the presentation, all of our financing does require that we consider these social benefits as part of our overall financing strategy. Again, it's part of stimulating economic development and really pushing that agenda forward. Types of traditional credit facilities. There are a plethora of credit facilities out in the marketplace that a business owner can leverage. And they can leverage them to finance capital, they can leverage them to finance assets and growth as well. It's convoluted and it's really, it can be a scary place when you're confronted with all these particular options. To boil it down, from a working capital perspective, we would be looking at a credit facility to finance working capital for things such as inventory, accounts receivable, and operating expenses. For these particular type of needs, you should probably seek a line of credit. Lines of credit are short-term. They generally revolve for 12 to 24 months and typically have a variable interest rate. The repayment is generally interest only, and it's not uncommon for some lenders to require that outstanding balances be paid in full at least once a year. These credit facilities are typically secured by a lien on all available business assets and really are meant to provide that steady availability of cash flow provided the business owner is using it accordingly. They are revolving. They don't last forever. So generally speaking, you'll find that some of these revolvers are typically requiring that a client reapply every 12 or 24 months, but they provide such a solid safety net of capital that a business can rely on. Generally speaking, if you're looking for working capital, we would always acknowledge the fact that there are credit cards available and there are lines of credit, which in essence, they are the same. However, a line of credit through a bank can be a much more cost-saving credit facility to take advantage of. It could be a much larger credit facility to leverage. And again, it's something that's going to be there at all times, provided it's being utilized accordingly. For fixed asset needs, such as furniture, fixtures, equipment, and real estate, as well as leasehold improvements, businesses should really seek a term loan in these particular instances. Term loans are longer term, anywhere between 1 to 10 years, and generally come equipped with a fixed interest rate. Repayment is typically based on principal and interest, and they're always secured by the fixed asset, and in some cases more if there's a collateral deficiency. Commercial mortgages, which are also considered a type of term loan and is only used for real estate purposes, are also considered a term loan. They are long-term. Terms range between 10 and 25 years, and depending on the lender, rates may be variable or fixed. Federal financing programs. There are several financing programs available in the marketplace. And really, most of these financing programs all support economic development initiatives and can be used to finance the capital needs we've been discussing. The most common sources of federal financing are, and I'm going to use acronyms here. I'll put my banker hat here. It's sources available through the SBA, EDA, HUD, USDA, and CDFI funds. The most important thing to know here is that these funding sources can only be obtained through intermediaries such as banks, CDCs, CDFIs, and many other public and or private organizations. The only time you'll really be able to approach any of these organizations is for disaster recovery financing. So EIDL loans, if you recall that particular product, the only way to get access to that particular product was by going directly to the SBA. You'll find that in some cases like Hurricane Irene, when there was support for areas that suffered some disastrous effects by it, if you needed to seek assistance for it, you had to go directly to the SBA. But for all other programs that the SBA backs and guarantees, you have to go through an intermediary. I figured I wanted to spend a little bit of time on some of the SBA lending programs that are out there. Certainly the two sort of categories that are listed on the screen are not the only SBA lending programs available in the marketplace. There are many others. My organization, again, is an SBA licensed administrator of these particular programs. So I figured I'd touch on some of the programs that we offer. So on the left, Through the 504 loan offering, we can finance owner-occupied commercial real estate transactions and long-term machinery and equipment acquisitions. In both cases, we can generally provide up to 90% financing, and the client can include renovation costs, equipment installation fees, and many other ancillary costs. Really, the key to this program is that it allows a client to conserve their valuable operating capital. What's interesting about this product has actually been around since the late 1940s. And throughout all these years, the momentum and really the awareness of this program has grown substantially. I'd say, and I'd argue that over the last 2 years throughout COVID, many businesses realize that there's an opportunity to expand if they had the luck and the good fortune of being able to do so. And I'm very happy to say that the 504 program was widely used because of the ability to conserve valuable operating capital. So in a typical 504 scenario, the loan is structured so that a banking partner will participate with us on a project. The bank would finance 50% of the total project, and the SBA would finance 40%. That 40% would come through an organization such as CIC. That 40% does have a cap on it. The maximum is $5 million in a standard transaction. In some cases, if we're providing financing for a green energy project or if we're providing financing to a manufacturer, that cap actually extends to $5.5 million. The SBA does give the borrower a choice between a 10, 20, or 25-year term on their portion of the loan, and the interest rate is fixed for the entire term. As of today, the rates are still relatively low. The rate on a 25-year loan would be fixed for the life of the loan at 3.6%. On the community lending side, this is essentially a mixture of two particular programs. We have the microloan program and the Community Advantage loan program. The Community Advantage is a small subset of what's widely known as the SBA 7A program. This particular subset is only available through organizations such as CIC and other organizations out there who are considered nonprofit mission-based lenders. Both of these products allow us to provide financing to startups or existing businesses that are not quite ready for traditional financing. These particular programs give us the ability to leverage riskier transactions and provides opportunity where opportunity may be limited. As you can imagine, these past few years, because of COVID and the impact it's had on the business community, these community lending products have really become a safety net for many businesses across the state. We try to position this particular product as sort of a bridge. Whenever a banking partner has a client that they try to assist and for whatever reason can't, we step in as a partner and provide financing through these community lending programs. And really the idea here is that we want to provide a bridge. We want to see a client either start that business or rebound from a poor situation. We'll step in and provide technical assistance, some business advisory. The idea is we want to get the client to a bankable scenario so that they can ultimately go to a bank and obtain a more conventional finance structure. In these particular programs, generally we can lend up to $250,000, and we can finance a wide gamut of needs such as working capital, equipment, and even real estate. The loan amounts will typically dictate the terms, but generally we can provide up to a 10-year term in either a variable or fixed interest rate. I will say that in some cases, if we're financing real estate through the Community Advantage program, we could actually provide a 25-year program, which is very unique. Bud, any questions out there that we could answer?
Actually, yes, there's a couple I wanted to throw at you.
Great.
First one is, could you give an example of a hard money lender?
Sure. Let's see. There are companies out there like I'd say Pursuit or let's see. There's a couple in Connecticut, and of course the names escape me. But generally speaking, these organizations are private. They're utilizing funds from private sources. They are not backed by the federal government. They are not backed by a bank or any other type of organization. And really hard money lenders will provide a much necessary credit facility to a borrower, but it comes with a cost. You'll find that these interest rates that folks are charging are very high, upwards in the teens, I've seen in some cases, and they can be very costly to close. So in some cases, I'll see a hard money lender charge 2 and 3 percentage points on the particular request, simply for being able to provide that credit facility to the particular borrower. It's a costly endeavor, however, they do serve a purpose in the marketplace. We often find that we find ourselves refinancing a lot of private loans into either a community lending loan or a 504 loan. And then ultimately down the road, as a client expands, they end up getting more of a conventional type of financing structure. At the end of the day, hard money lenders provide a platform or a stepping stone for that particular business owner.
Would you say then that a hard money lender is somebody who a high risk business may be needing to use?
Correct.
Okay. Second item was debt-quity sounds like a very family-oriented item. Does it expand out of just the family, or that small group that you try to hit up on in the first round?
Yeah, equity can also be done in the form of a venture capital firm. Some companies don't want to be out there for a long time waiting for either a product to launch or just want to be repaid very quickly. It's a difference between patient capital and or debt, right? So when you mash the two together, that equity piece, whether it's friends or families or any type of investor, if they put a term on it and they want to get repaid very quickly, that's when I would call that equity.
Okay. You had mentioned credit facilities. Is that the same as a credit union?
It is not. Credit facilities is another term for a credit product or an actual loan. Credit unions are a type of organization that provides credit facilities, if you will, but they are different.
Okay. Kenny had asked for qualifications for these programs, but didn't specify which programs. If you could be a little specific on that, Kenny, we'll come back to it. Had another question. In general, I'm wary of borrowing money because of the interest. Should I be looking at interest as a cost of doing business and price it into my business model? Great question.
Absolutely fantastic question. It's a point that I was going to bring up later on down the road. Sometimes access to capital does come with a cost. And oftentimes startup businesses or entrepreneurs disregard the cost of capital for the sake of having access to capital. So I would certainly urge that particular business owner or that entrepreneur to certainly include the cost of capital in their business model, because at the end of the day, if it's a means to get started, then you would have accomplished what you needed to accomplish, and then you'll just have to work really hard and become profitable so you can offset that cost later on.
Okay, Janet had a question. What are the rate ranges for commercial lending loans currently?
They range drastically. So from a commercial real estate perspective, I'm seeing anywhere between low 4% range to the mid 5% range. It generally depends on the type of property, it depends on the industry, and it depends on the credit profile of that particular business and borrower. From a term loan perspective, meaning we're providing a short-term loan for either equipment and or inventory or what have you, those loans are generally priced against the Wall Street Journal. So you'll typically see that it's prime plus a particular spread. So I've been seeing anywhere between prime plus 1% to prime plus 4%, depending on the need, depending on the credit background as well.
Great. Kenny got back to us. Thank you. The question more specifically is, what are the qualifications for SBA loan and community lending?
They range drastically. So much so that it's very hard to pinpoint specific credit qualifications, if you will. That said, I will say that from a cash flow perspective, one of the biggest qualifications is that you have to demonstrate the ability to service the debt that you will be taking on. And if you're an existing business, we want to make sure that historically the business can service that particular piece of debt. Or if you can't, then we're going to rely on projections. I'll touch base on the 4 sort of primary C's of credit that really demonstrates the primary qualifications. Every organization varies because we govern our own programs and we provide and write our own credit policies. I'd say from a CIC perspective, you can certainly go to our website and see those particular standard qualifications listed there if you wanted to.
Great. I just wanted to confirm something that you had said earlier when you were talking about banks would, in all probability, have a lower interest rate than if you were to use a credit card to do the financing of your business.
Correct. That is accurate. If a client is an existing business and they're looking to obtain a line of credit through a bank, it's typically going to be based on the Wall Street Journal Prime. That Wall Street Journal Prime rate today is 3.25%, and depending on the credit profile, the bank could be adding a spread on top of that. So let's say it's Prime plus 3%, the client would be paying 6.25% on a line of credit, as opposed to probably paying somewhere in between the 10 and 20% range on a business credit card. Of course, there are those instances where or credit card companies are providing 0% introductory rates. The reality is, once that introductory rate expires, the rate that remains ahead could very much be higher than a conventional line of credit through a bank.
Got it. Just want to confirm what I'm seeing here on your SBA loans. Am I correct in seeing that the SBA would allow funding for you to buy a building?
You're absolutely correct. The 7A product allows you to do that. And more importantly, the SBA 504 loan product allows you to do that. There are very specific qualifications in terms of being eligible. Most of them, on a very basic basis, you have to be a for-profit company. You cannot be a nonprofit company. The business owner has to be willing and able to occupy at least 51% of the commercial property in order to qualify. And you can't be in any one of those sin industries that would typically be considered, such as gambling and what have you. Provided you're a business, provided you can occupy 51%, it's likely, if you don't fall out of that category of being ineligible, that you can finance commercial real estate through the SBA. I will say one of the biggest conversations we have is that whenever someone is looking to buy an investment property, or there's an investor that wants to purchase a property and rent it and or flip it, if that's their business, technically speaking, that particular business owner isn't going to be occupying 51% of that particular property. So that particular industry is considered ineligible from an SBA perspective.
Got it. Okay. Thank you very much. Why don't you continue, and looking forward to hearing more.
Great, will do. So general underwriting guidelines. As I mentioned, there are 4 primary considerations that must be made when underwriting a new loan request, what we call the 4 C's of credit. There are technically 7 C's, but generally speaking, whenever you're talking to a lender, these 4 are the most basic and the initial considerations that'll be made when looking at a potentially new request. So the first is capacity, also known as cash flow. That refers to the ability of the business to generate revenues to pay back the loan. If you're a startup business, that capacity is going to be based on projections. If you're an existing business, that capacity is going to be based on historical cash flow performance. That said, there might be a need for an existing business to have to rely on projections if historically cash flow has not demonstrated sufficient performance in order to service the potentially new debt request. The next consideration is character. This refers to the financial history of the borrower. Character is often determined by looking at the credit history, particularly as it is stated in the credit score. So we want to make sure that folks don't have collection accounts, that there hasn't been a recent bankruptcy, that there haven't been substantial late pays. I do say and commonly argue that it's very hard to judge character based on 3 numbers. It's all about looking at the history. It's all about understanding the story that we would typically try to determine character. Character also means that we want to make sure that the client hasn't been arrested or committed crimes that deem the individual ineligible from an SBA perspective. That also comes into the character calculation as well. The third consideration is collateral. Are the assets a business owner pledges to secure a loan? And that's essentially what we're determining. If we're providing a $100,000 loan, we want to be able to offset that loan with at least $100,000 worth of collateral. Generally speaking, from an SBA perspective, if there's insufficient collateral, it doesn't preclude you from obtaining financing. It does, however, mean that the lender could potentially be asking for additional collateral, such as a primary residence or an investment property. Again, if no other assets exist, it does not preclude the borrower from obtaining financing simply because of the basis of not having sufficient collateral for their request. The last consideration is capital. That refers to the cash or other equity that a business owner can contribute towards the financing request. Again, generally speaking, you would be hard pressed to find a lender that would be providing financing on a 100% basis to either a startup or an existing client. Capital or an equity contribution is absolutely key when looking at financing new potential needs. COVID-19 and financing assistance out there. I was hoping that Congress would have allowed that the Restaurant Revitalization Fund be replenished with funds and that it be made available to the community. They opted not to do that. So unfortunately, that is a funding source that will no longer be on the table. But that said, it also appears that most of the COVID funding resources that were available at the peak of the pandemic are essentially mostly gone at this point. That said, the SBA is continuing to provide increases to existing EIDL loans if you qualify for up to 2 years after the original EIDL loan has been granted. If that's of interest to you, I would certainly urge you to go directly to the SBA website to get more information. The EIDL loan does provide very, very inexpensive money, and it's provided at a very long-term term. So, folks, I believe the rate is just shy of, or just a little over 3%. And the term, I believe, is 30 years, if I'm not mistaken. So again, if you were in the need of capital and you were affected by COVID, that is a very good and a very cheap funding source. That said, in order to get money or increase your access to it, you would have to have an EIDL loan on the books already. Also, it does appear that the Department of Treasury is working on what they call the Emergency Capital Investment Program. That program is pretty unique. The Treasury will be providing up to $9 billion in capital to CDFIs and minority depository institutions to provide loans, grants, and forbearances for small businesses, minority-owned businesses, and consumers, especially if they are all located in low-income or underserved communities. I know that the state of Connecticut is working closely with the Department of Treasury. They recently put out an RFP for organizations such as CIC to essentially participate and help put most of this money that the state was awarded out on the street. So it's likely that there will be several announcements coming in the near term. I'm not sure what that date might be, but I know that there are many discussions out there that are happening whereby there could be some substantial money available to businesses in the state of Connecticut to leverage if they were affected by COVID-19. For the Treasury program that's being talked about, I'd certainly go to the Department of Treasury's website. I've listed the website in parentheses there. I happen to be looking at it today, and it does provide some pretty substantial information. That said, it does appear that states who are awarded this particular capital or this particular source of capital will be designing their own sort of qualifications for businesses to take advantage of it. Outside of financing assistance from COVID, it's important to just talk about how lenders are looking at businesses who were impacted by COVID. From our perspective, it's 2022. We're still considered in a pandemic. So every business that we look at today has had some COVID impact. In many cases, it's been negative. Other cases, it's been positive. That said, we're always asking for a COVID statement. We're trying to understand the COVID impact. We're trying to understand the pivot plan. And we're finding out if the client had to leverage additional debt in order to keep their doors open and keep people employed. Oftentimes, the answer is yes. People took advantage of PPP loans and EIDL loans, which we do not hold that against the client. They did exactly what they needed to do in order to survive. But we are looking at sort of this interim period where 2020 and 2021 financials may not look too good. And so we're looking beyond that. It's all about telling a story. We're looking at historically how that business has performed. But more importantly, if really the impact was substantial, it's not a dead end to obtaining financing. We're asking folks to provide projections, especially if they've implemented a pivot plan, whereby we can understand where they were and where they're headed. And we're basing our financial decisions on those projections, as well as we're basing decisions about according to the history that we've sort of unraveled in speaking with these particular borrowers. So just because you've been impacted by COVID, from a business perspective doesn't mean that you can't obtain financing. It does, however, require that a conversation be had with lenders so that they can understand how you're moving forward. So best practices for financing success. What are the most important things you need to know about borrowing? Number one, you've got to become familiar with what it takes to qualify for a loan. There's no such thing as starting a business with no money down. You certainly need money in order to make money, and for most people, that means that they need to borrow money. It does take time to get a loan. There's a lot involved, so be sure to start that process early and be committed. Loans are not easy to get, and they're certainly not supposed to be, but it's a process. You should be committed to it. There is something to be said about a process taking too long and that just becoming a very costly portion of the access to capital search. But in essence, if I look at a transaction today, it's likely going to take about 90 to 100 days, depending on the need, depending on the amount of the loan that's being requested in order for us to grant that particular financing request. The third bullet point here is you should be looking to enhance your borrower profile. And really, just from an overall business perspective, any business owner, generally speaking, that owns 20% or more of a company is required to provide a personal guarantee. So that person would be signing on behalf of the business and essentially stating that in the event that the business can't support debt, the personal guarantors are stepping in and willing to repay that debt in the event of a downturn. So all borrowers should be looking to enhance their credit scores. They should be looking to save money for the equity injection and for reserves. You should be assembling documents. You should be pulling together information for all the forms that are needed to be executed. And you should be lining up references. This sometimes strikes people as odd, but if you're a startup, part of the understanding the character, part of understanding sort of the history behind sort of your prospective business endeavors is talking to other people who know you. So having references that we can speak to is oftentimes a very important point in the discovery phase where we would essentially determine whether we can move forward or not. Not to say that that's going to be the end all, but some folks who can vouch for you as an individual and for your business opportunity is very important. Just to continue along best practices, you should really be working on enhancing your business profile. If you're a startup, I would really stress the importance of conducting a business case analysis. You really have to prove viability and feasibility, and then that dovetails into preparing a business plan and financial projections. The business case analysis is very important because it's really going to tell you whether or not you've got a solid business opportunity. And if you do, that's when you would project, or that's when you move forward and produce your business plan and financial projections. If the business case analysis does render a negative sort of outlook, it's either back to the drawing board to come up with a new idea, or it's you abandon perhaps the business opportunity and you seek to go in another direction. But it does yield substantial information. We call it the point of truth because it really does give you sort of a 360 view on owning a business and every single aspect of a business that you should be considering, especially if you're starting a new business. The next bullet point is to be sure you borrow enough money. I said it earlier, startups and existing businesses looking to either start or expand often fail because they are undercapitalized. So we would always urge folks to seek additional money in the event that either the request is too high, we start to peel it back to demonstrate the ability for the business to support it, and or in some cases, we do what's called a cash burn analysis. We say for a business owner, they're requesting $50,000 for working capital, they've provided us with projections. We're essentially analyzing how long that $50,000 is going to last them. So that's a very critical moment in time where we say, hey, Mr. Borrower, $50,000 is only going to last you 3 months as an example. You should perhaps increase that because this is sort of the runway that you would have if you were to increase that working capital position. Again, our goal is to make sure that whenever we're providing financing, that business is going to continue to be successful. So we would be doing our borrowers a disservice if we didn't go through that rigorous analysis to make sure that we're providing and supporting a business endeavor the way we should be in a proper manner. I would say that you should remain performing and avoid default, especially if a loan has been granted. Defaulting on a loan could be onerous, so make sure your business is viable and feasible. And just to kind of give you a rundown on how the application process starts, the process usually starts with information collection. then you're going into underwriting, then it's approval, then it's closing, and then it's servicing and post-closing compliance. On paper, it sounds very simple. There are a lot of steps along the way. There's a lot of discussions that take place. And it can be a long and arduous process, but you've got to stay committed because it's, the end is really a promising and successful opportunity, perhaps for many businesses out there. And I wanted to really finish the presentation by talking about some success stories. These particular success stories were our CIC borrowers. We've leveraged some of the loan programs that we have here at CIC, but more importantly, these particular scenarios happened throughout COVID. So again, these are examples whereby people are being affected by COVID, but it doesn't necessarily preclude you or stop you from looking to advance your business and or start one. So this first success story is a loan that I did for a company called RugPad USA. We partnered with Webster Bank in this particular transaction. The total project size was $10,650,000. When we provided this client with a 504 loan, our portion of the loan ended up being $4.26 million. They ended up leveraging that loan for long term and really capitalized on a very low interest rate at the time. RugPad's a manufacturer of custom cut pads for carpet, laminate, stone, and tile, and they could sell their products worldwide via a variety of e-commerce channels. I often say that if you didn't think that rug pads could be developed or manufactured in Connecticut, well, here's a perfect example. They, at the time, were in expansion mode and really bursting at the seams in their facility at the time. They opted to purchase this large and beautiful site in Suffield to serve as their headquarters and really their primary manufacturing and distribution hub. Unfortunately, every transaction in some way, shape, or form has a twisting turn that happens. In this particular case, if you're familiar with CTDEP and the Transfer Act here in Connecticut, this site was considered an establishment and needed a remediation. That said, that doesn't preclude you from moving forward. The SBA will allow for a transaction to be closed if the borrower is willing to establish an escrow account for 150% of the total estimated cost of the required remediation. Thankfully, the borrower had the means to do so. We quickly established that escrow account, and it really just became a favorable scenario. Generally speaking, it almost seems as though every transaction does have a very tight closing deadline associated with it. This transaction, when you layer in the establishment piece, did layer in many moving parts. However, with the proper planning, with the banking partner, with the borrower, and all the advisors that come into play, we were actually able to close this transaction in 58 business days. Most often than not, folks, when they hear SBA and they think of financing, they think of this long, drawn out, arduous process. But frankly, if you pair yourself with a reputable banking partner, with the right firm, if you're seeking 504, such as CIC, and if you align yourself with a great advisory team, there's nothing that says that we can't close transactions faster than the norm. The last success story that I'll share with the group is a story on Saugatuck Kitchens. They're located in Stratford. They're a longstanding client of ours. We financed a couple of buildings for this particular organization as they've grown throughout the years. They're a Hispanic and woman-owned food manufacturer. They've been in business since 1998. And these folks were severely impacted by COVID-19 to the point where they were ready to lay off substantial amounts of people and really just bring their business to a screeching halt. We sat down with them. We tried to understand what their working capital needs were. And we also tried to understand how they were able to come out of this. These particular folks are purveyors in hors d'oeuvres. If there are any golfers on the call, they actually make hors d'oeuvres for Augusta National and several other well-known facilities out in and across the country. So as you can imagine, weddings weren't happening. People weren't attending golf tournaments and what have you. So their production of these these phenomenal hors d'oeuvres came to a screeching halt. So we try to understand that pivot plan. They were able to seek out new clients through major restaurants and supermarket chains, whereby they were able to create products that they needed to sell almost on an immediate basis. And so through that understanding and through that planning, we were able to leverage two of our community lending products to provide them with a tranche of cash for working capital, whereby they were able to keep all of their staff employed. Plus, they ended up hiring several dozens of additional employees as well. And they also needed equipment to sort of pivot and go in this new trajectory. So we were able to finance that equipment need. And I can happily say that since the funding has taken place, this company has completely rebounded from COVID. They have grown substantially, and really what used to be, I'd say, a small organization has really grown substantially, and they're seeing growth in areas that they've never seen growth before. So with that, that'll conclude my presentation. It's been an absolute pleasure speaking with you all. I hope that the information that I shared with you all this evening was insightful. Certainly, we can go on and on. There are so many aspects of financing and funding that need to be considered. So we wanted to be able to put information together that was simple and that was done in a concise manner to really just provide business owners with a simplistic view on how to structure sort of their search for capital. So Bud, with that, I'll turn it over to you.
There's a few more questions. So first off, what's a good rule of thumb for extra money to add to your ask? 50%, 100%? What's your thought?
You know, it's tough. I'd probably say anywhere between 25% and 50% is probably a good rule of thumb. It does range drastically. Sometimes 100% is even warranted, especially if you created a set of projections and really haven't tabulated how long that initial ask would run. So you know, it's likely that we would probably come back and say, hey, you need to either increase this substantially or decrease it because you've asked too much money and you're essentially going to be paying interest on the cash that your business can demonstrate that it's going to generate on a much faster basis.
Okay. Next one. Does there need to be a consistent minimum monthly revenue of 10,000 per month or whatever before a loan can be procured?
Definitely not. I don't know that I've ever seen a business that has provided or demonstrated consistent revenue on a month-over-month basis. Every business is different. Every business has ebbs and flows in their cash flow. I'd say that what you want to hone in on is sort of that free cash flow number, right? So if you're an existing business, if you want to ask for more money through a loan, generally speaking, a lender is going to want to make sure that you sort of meet the specific, what's called a debt service ratio. So I'll give you an example. If you're asking for $100,000 worth of debt and it costs you $100,000 worth of cash flow, if you will, to service it, the bank wants to make sure that for every $100,000 worth of debt, that you're going to be producing $120,000 of free cash flow to service it. So that's what we would call a 1.2 times debt service coverage ratio. That's pretty standard in the industry. It's 1.2 to 1.2 times, or 1.25 times, if you will. So again, the example is such that if it costs you $100,000 to obtain a loan, you need to demonstrate to your lender that you're at least making $120,000 to cover that particular new loan request. Every bank is different, but that's a really good sort of starting point to understand free cash flow.
Okay, I have one question. I want to go back to collateral because I have always found it to be a particularly scary concept. The notion that I want to open a restaurant and if it doesn't work, you're going to take my house. That's kind of scary to some people. So you had mentioned the phrase point of truth, and with that as that discussion area, how do you mitigate the fear of collateral?
Yeah, it's always a very tough conversation. I'll be honest, the fear is, I don't think it ever goes away. I don't think that there's a way to mitigate it. There is a way, however, to talk through it, right? And it's really just understanding sort of the boundaries in terms of what happens in a liquidation, and or what happens in just a scenario where business goes sideways. You know, in a restaurant scenario, if we have $100,000 worth of equipment, but we've also taken a personal residence as additional collateral, the client only owes $50,000 on their credit facility, and we're able to pay off the existing debt through the sale of the existing restaurant equipment, the house never comes into the picture. So it's just really informing the borrower about the ways in which collateral is liquidated and or how businesses can survive in the event of a downturn, and really just understanding that it's all about full transparency, and it is a tremendous risk when you're a business owner and you also put up personal property on the line to sort of finance your dreams. I don't know that answers the question, but I'd argue that it's all about having a full, truthful conversation whereby there's transparency and really just understanding the pros and cons.
Well, Louis, that was really excellent. You did a great job of making things clear, concise, understandable. And from SCORE, I'd like to thank you. I'd also like to thank the Monroe Chamber of Commerce, the Monroe Economic Development Commission, and the Monroe Library in planning this webinar with us. As we'd said earlier, this is the fourth in a series of 6 webinars. The 5th webinar will be on March 17th at noon with Cliff Enico. And as a reminder, a recording of this webinar and the materials will be available within a couple of days on the fairfieldcounty.score.org website. Please check our website for information on upcoming webinars. And again, SCORE offers free individual counseling, so please use the Request a Mentor click on our website. And as I said earlier, we're available for sessions by phone, email, or video. Please fill out your evaluation that will be sent at the end of this webinar. And on behalf of SCORE, I'd like to thank you all for attending today's live event. In closing today, a big thank you to Louis, and enjoy the rest of your evening, everyone.
Thank you, everyone. It's been a pleasure.